You did the responsible thing. You saved money. You built a buffer. You tried not to spend everything you earned. And yet, somehow, you still do not feel safe. One car repair feels threatening. One rent increase feels personal. One job interruption feels like it could undo years of effort. That feeling is confusing because savings are supposed to create peace. But sometimes savings do not feel like security. They feel like a thin wall between you and financial pressure. Not because you failed. Not because saving was pointless. But because your savings may not be strong enough for the system they are trying to protect. This video is an audit of that system. Imagine two people. Both have $10,000 in savings. On paper, they look similar. Same emergency fund, same account balance, same feeling of having done something responsible. But one person feels calm. The other still feels exposed. The difference is not the amount sitting in the account. The difference is what that money has to defend against. For one person, $10,000 covers several months of basic life. For the other, it barely survives a month and a half of rent, bills, car payments, debt, groceries, insurance, and family obligations. Same savings, different structure. That is why the real audit question is not, how much money do you have saved? The real question is, how much protection does that money actually buy? Because savings are not automatically security. Savings only become security when they are large enough, liquid enough, and protected enough to absorb real pressure. So today, we are going to run the Savings Safety Audit, not to shame the amount you have saved, but to reveal whether your savings are actually protecting you or simply making your financial life look safer than it really is. Most people measure savings by the balance. $1,000, $5,000, $10,000, $25,000. But the balance alone does not tell you much. A $10,000 emergency fund can be strong in one household and fragile in another. It depends on the structure around it. How high are your fixed costs? How fast does money leave your account every month? How much of your savings is truly available tomorrow? How much debt pressure are you carrying? How quickly can you rebuild the money after you use it? This is where many people get surprised. They have a savings balance, but not enough protection. The account looks responsible. The structure still feels exposed. That gap is what creates the anxiety. Your brain can feel when the numbers are thinner than they look, even if the account balance looks responsible, even if you have more saved than before, even if you are doing better than many people around you. If the structure is fragile, the safety does not feel real. The first audit finding is simple. Savings should not only be measured as a dollar amount, they should be measured as time. If your income stopped today, how many months could your life continue without panic? That number is your liquidity runway. And for many people, this is where the fear comes from. They might have $5,000 saved, but if their basic monthly obligations are $4,000, that is not a large emergency fund. That is a little over 1 month of survival. If they have $10,000 saved, but their fixed costs are $6,000 a month, that is still less than 2 months of true protection. The savings number looks good. The runway is short, and a short runway creates emotional pressure. When the runway is short, normal interruptions start to feel urgent. Job loss, medical bills, car repairs, and family emergencies all move from inconvenient to threatening. Not because the person has no money, but because the money does not buy enough time. Security is not just cash. Security is time under pressure. The second finding is fixed cost pressure. Most people think savings fail because they spend too much on small things. Coffee, takeout, subscriptions, shopping. Those things can matter. But the bigger danger is usually fixed obligations: rent, mortgage, car payment, insurance, debt minimums, phone plans, childcare, utilities, student loans. These costs reset every month, whether life is easy or difficult. They do not care if your income falls. They do not care if you are tired. They do not care if an emergency arrives. And the higher they are, the weaker your savings become. This is the hidden problem. Your emergency fund is not protecting your income. It is protecting your cost structure. If your cost structure is heavy, your savings have to work much harder. That is why two people can both have $10,000 saved, but feel completely different. One has low fixed commitments, so their savings stretch. The other has high fixed commitments, so their savings vanish quickly. Your savings are only as strong as the monthly pressure they must absorb. Finding is access. Not all saved money is equally useful in a real emergency. Money in a retirement account may be part of your net worth, but it may not help tomorrow unless there are no penalties, no delays, no taxes, and no bad timing. Money invested in the market may be valuable, but it can fall at the exact moment you need it. Money set aside for taxes, tuition, a business expense, or a planned purchase may technically be cash, but emotionally and practically, it is already assigned. This is why some people feel unsafe even though they technically have money. The money exists, but some of it is locked, reserved, volatile, or already spoken for. Real emergency savings need three qualities. They must be accessible, they must be stable, and they must be unassigned. If the money fails one of those tests, it may still be useful, but it should not be counted as full. The fourth finding is debt pressure. Debt changes the meaning of savings. If you have $8,000 saved but also carry high interest debt, your financial life may still feel unstable, because part of your system is moving backward while another part is trying to move forward. Savings create a buffer. Debt creates a drain, and if the drain is strong enough, the buffer never feels peaceful. This is especially true when monthly debt payments are high. The money in savings may look like progress, but the debt payments reduce margin every month. That means if an emergency happens, you are not just covering the emergency. You are covering the emergency while still feeding the debt system. So when someone says, "I have savings, but I still feel trapped," they may be describing the structure accurately. Their savings are sitting inside a structure that is still pulling money away from them. The audit is not saying you should have no savings until debt is gone. That would be risky. The audit is saying you have to understand. The fifth finding is rebuild capacity. This is the part many people overlook. An emergency fund is not only about what happens when you use it, it is also about what happens after. If you spend $3,000 from savings, how long does it take to rebuild? 1 month? 3 months? 1 year? Never? This depends on margin. Margin is the money left after your obligations. If your monthly margin is strong, savings can recover. If your margin is thin, every emergency becomes permanent damage. That is when savings stop feeling like security, because deep down you know that if you use the money, it will be difficult to replace. So you have savings, but you are afraid to touch them. The cushion exists, but using it feels like losing the progress you worked hard to build. That is not real safety. So, how do you make savings feel like real security? There are 3 structural corrections. First, convert your savings balance into runway. Stop asking only, "How much do I have saved?" Start asking, How many months does this protect me? Take your true monthly essentials: housing, food, utilities, insurance, minimum debt payments, transportation, basic family obligations. Then divide your usable emergency savings by that number. That gives you your true runway. This one calculation changes the entire conversation. $10,000 may be strong, or it may be fragile. The runway tells the truth. Second, lower the pressure your savings must defend against. The fastest way to make savings stronger is not always saving more. Sometimes it is reducing what your savings has to protect. Lifestyle upgrades that turn flexibility into obligation. When fixed costs fall, every dollar of savings becomes more powerful. Your emergency fund stretches further, your runway expands, and the same balance starts to feel more protective. You can increase safety without adding a single dollar, simply by reducing the monthly pressure on the system. Third, rebuild capacity. Savings become safer when you can replace them. That means your monthly margin matters. If your emergency fund is used, there should be a path to rebuild it. Automatic transfers, lower fixed costs, temporary spending controls, debt reduction, extra income if needed. The goal is not just to have savings. The goal is to have a system that can regenerate savings after life uses them. That is when the anxiety starts to fall, because the money but savings alone are not the same as safety. Safety depends on what your savings can survive. If your fixed costs are heavy, your runway is short, your debt pressure is high, and your monthly margin is thin, even a decent savings balance can feel fragile. That does not mean you are failing. It means the audit is revealing the real problem. Your savings may be carrying too much weight. The goal is not just to save money. The goal is to build a structure where your savings can actually protect you, where your emergency fund buys time, your fixed costs leave room to move, and your margin can rebuild what life interrupts. That is when savings become security, not because the account balance is impressive, but because the structure behind it is strong. The final audit verdict is this: savings are not security.